Hi, Greg Weldon back at you as the host of Money, Markets, and New Age Investing. And the last podcast I did, I just looked back and it was June 22nd. And what's interesting about June 22nd is I had just busted out of the Seniors World Championship at the World Series of Poker in Las Vegas, staying at the Paris Hotel, which is just a great place. I really love it there last couple of years. And it I don't gamble. I play poker. It's like I look at markets. First of all, markets are taking risks that already exist and providing some kind of service in terms of liquidity and other sides of the markets for producers and users of certain commodities or currencies or whatever, versus gambling, which is risk for risk's sake created out of nowhere that didn't exist until you created it. I play poker because it's mathematically very similar to trading and money management and the way you go about the entire thing from the top down. I don't play any other game. I don't bet on any other thing. I don't bet on sports. I don't bet on craps. I don't bet on roulette. I don't play blackjack because the house has the advantage. The house has the math. I'm a math guy. I'm a math geek. I'm not a gambler, but it leads to poker. And what's interesting about it is the last 3 to 4 months have been tough for our industry in terms of hedge funds and CTAs, and I'm a Series 3 licensed, commodity trading advisor with individually managed accounts, and we are down a little bit since the end of the first quarter. Now, this is coming off a near 30% up year last year and a well over 100% run over the last 5 years. So, a drawdown within the probability curve is something to be expected many, many times. It's kind of normal, as would be having a run of losing hands in a game of poker, okay? Because you can think you're going to take all the luck out of it. And in this case, in the markets, I would say you can think you can take all the uncertainty out of it. But when you have a war going on and the leader of one side is telling you he's going to wipe out the civilization one day, and the next day tells you this country's begging for a deal, it's really difficult to handicap that. All right. And in the context of the markets kind of went nowhere while going up and down a lot. And I just look, we're having again a minimal drawdown, not even double digits when you have a lot of AI, hedge funds are down 20 to 40% already, depending on which stocks and which countries they hold. But it's funny because it's just part of being a trader. I mean, you're going to have losses. It's just the way it goes. There's no straight line to the upside. And normally my loss dynamic is around being early as opposed to being wrong. Certainly wrong enough. There's no doubt that I'm wrong. I mean, again, part of being in the business. It's kind of like baseball. If you can, hit the ball 3 out of 10 times at bat, you go in the Hall of Fame. Now, the math is different in trading, but if you can provide 3-to-1 profits and losses and be right 60% of the time, you're going to make money. All right. So a lot of it's mathematical. It reminds me of a couple, and it's funny because I played in a World Series. I started in 2006 playing. I actually had won in a tournament in St. Croix in 2005 and started in 2006, sat next to the 2005 winner, Joe Hatcham, for an entire day. And we became pretty tight friends, a really cool guy. But the point is the bad beats. And just my two worst beats in poker. And this year was only the second year since I've been going, not every year, but many, many years since 2006. Only the second time I didn't make money, didn't cash, in at least one, if not, as many as three major tournaments. All right. So my first bad beat story is pretty interesting because you think you can't lose. All right. But you can, and you can lose quickly before you know it. And this is why money management is very important in terms of the markets. All right. It was the six-handed world championship back in 2014. It was day one of a 4-day tournament, six-handed at the table. First three hands of the tournament, not even like in between hands. First three dealt hands to me. Pocket queens, I lose. Pocket kings, I lose. Pocket aces, I lose. Best three hands in poker, first three hands of the tournament, and I am out in 10 minutes for what should have been a 4-day tournament. Now, there's nothing I can do about that. It's kind of funny because I had a friend of mine there who came out to play, and he was waiting in line for a sit and go, which means you pay your money and you wait for 9 other people to come in. And once you got 9 entrants, you sit and play the tournament. So he's waiting. He's already bought a seat. There's maybe 4 people in, so they're waiting for 5 more people. And he sees me and he goes, "What are you doing?" I go, "Dude, I'm out." He's like, "No way. No, you can't be out." I'm like, "Oh, I'm out." And I told him the story, and he was blown away. He says, "Well, you want to play the sit and go with me?" I said, "Dude, the poker gods have spoken. I'm not playing any more poker today, all right? There's no way I'm sitting back down at a poker table." We ended up going out that afternoon and having a really good time. The other beat was even worse, though, and bear with me with the story because it does apply to what we're going to talk about here today. That I was down to 28 players in a major tournament. This was a 5-figure cash already locked up, but get to 27. One more elimination would have ended the day, and you play down to 3 tables no matter how long it takes. It was 3:45 in the morning. We're still at 28 people. Now, even more than that, earlier in the day, I'd run into a friend of mine from my golf club in New Jersey. He was a member of a golf club. We played golf together in a tournament one time and so on and so forth. So I'm like, what are you doing here? And he goes, well, I work the ABC. We work for ABC. We're the film company that films the WSOP and does all the legwork. So I'm like, you got to be kidding me. He goes, and he's asked me, what are you doing? I'm in, down at the end here of day 2, waiting for 3 tables of this tournament. He goes, well, you know what? I mean, if you make it to day 3, I will do a full features piece on you. We'll go to your house. We'll film your home game. He knew I had a home game. He didn't play poker. We'll go to the golf club, include the country club Pine Barrens in Jackson, New Jersey. And I was like, holy mackerel. So we're down to 28. It's 3:45 in the morning. This guy who barely speaks any English is playing very passively, calls from first position. And you're late in a tournament like this, it's raise, re-raise, re-raise. Calling is just not something someone does, especially first position, unless they don't know what they're doing, which he kind of looked like he didn't. And someone like that can get lucky and make it pretty deep in the tournament, or he has pocket aces trying to trap somebody. I didn't put him on a trap. I just didn't. There's no way. I mean, it was almost just, I didn't have to really even think about it much. It folds around to me. I got pocket eights. I go all in. It's all of his chips too, right? And it folds around to him and he calls. And, I'm going to have like nothing left, not even like a quarter of next big blind. We basically had the same stack. He folds over pocket twos. Now, he never should have called. He should have, if anything, raised or even gone all in from first position with his chip stack. And I might have even folded eights had he done that from first position. But my read was right. He didn't have aces. He had pocket twos. Now, the guy next to me is a bracelet winning pro that I happen to know pretty well and got to really have some camaraderie with him during the tournament. And he turns to me and goes, you're in good shape. I folded a 2. Board on the flop is clean. First 3 cards, no 2. Fourth card, the turn, no 2. I'm 97.8% to win this hand and be on ESPN in a featured piece in 2014, and a 2 hits the felt. This is a bad beat. This is the game. And it's the same in trading. You're going to have losses. You can't let the losses ruin your bankroll. So if I was betting, every dime I had on this, I would never do that, even with 97.8% chance. So that's kind of a money lesson learned, and also a lesson learned that losses happen. It's part of the game. You can't be emotionally tied. And frankly, I will admit personally, because I'll always be as transparent as I can about this kind of thing, because that's the way you might get some clues or tips or pointers from me, gosh forbid, after 40-something years, that I usually am totally disconnected from the results until the last 4 months, because it's been so frustrating because things are changing with no real rhyme or reason to them. And the macro data didn't matter. And this is the point, because the bad beat is over. All right. We're back to playing the odds. Why? Because the macro data is going to take center stage here. Okay. I will talk a little bit about the Middle East in a minute, but really this is now the moment we've kind of been waiting for. We can talk about the macro data for months and months and months. It hasn't mattered. And there were months I didn't even write about it because it didn't matter. We were still trying to handicap gasoline, Trump, Iran, and this entire cluster, you know what, because that's what it is. I've been talking about a disinflation from within, a basically hollowing out of the labor market, like all year. I mean, seriously. And to the degree that this would be the kind of the unwinding of this Fed push to, pursue a tighter policy because of inflation, I also said the Fed will be forced at some point to acquiesce to higher inflation to protect domestic final demand, aka consumers. Well, it's kind of like it always is, where it's inside the data, it's underneath the ground, it's in the macro is in the micro. And until it sprouts above ground and everyone sees it, all of a sudden it's an epiphany. We just got that on Friday with the payroll employment report. An epiphany, a holy shit moment that what I've been saying, first of all, is right. And I don't mean anyone else is saying that because get followed by that many people. But it's like, holy shit moment, like this is right. Like the labor market is not what everyone is saying about it. Wall Street types, the pop media financial media, talking heads on TV, and all the politicians, that the labor market is quote unquote solid. That term, solid, that word has been used more than any other word by this basically horde of people that are so invested in making sure the stock market doesn't come down that they will talk whatever narrative will keep it up, including that the labor market is strong. If they looked into the data at all underneath the surface, they would realize that is a fraudulent statement. All right. Let's look at the facts, the numbers, the math. We take the rolling 12-month change in total employment. These are numbers that we can track back all the way to the 50s, the 1950s. And every recession was preceded by a similar sequence of events to every other one, and similar to what's happening now. All right. 12-month change in the number of total private employment in this country. All right. This is usually running 2% or somewhere north of 2 million a year, almost always, except when it's not. And right now, it's at 316,000. It's not at a million. It's not at 1.5 million. It's at 316,000. That's down 21.6% for the month. It's the third lowest since the pandemic. And February was the lowest at 126. So you're talking about 126, 403, 316. Okay. Any time and every time that the total 12-month change in employment in the U.S., private employment, has fallen below 1.5 million, it's led to a recession. It's led to a recession. Now, let's talk about the number not in the labor force. Over the last 12 months, the number not in the labor force has risen by 2.82 million people. So let's compare. And that's up from 2.6 and up from 2.08. So let's compare. 2.8 million, 82 million, 2.82 million dropped out just in the month. Over the past 12 months, 2.8 million versus new jobs of 316,000. That's a 9-to-1 ratio, 8.98 something. It's 9-to-1. Now, what's even more interesting about that is that there's only two other times when that ratio has been as wide as it is. In other words, 9-to-1 in terms of people dropping out versus new jobs. 2008 and 9. Really, it's the aftermath of that. It was 2010, 11, after 2008, 9. But because of 2008 and 9 and the pandemic. And now that's it. 3 times. That's the only 3 times. And now that's it. More than that, we've been below 1.5 million since 2024. Inflation's been above 2% target for 65 months. That's 5 years plus. And now you're talking 2 years where the labor market is in recession foreboding territory. This is stagflation. I've been talking stagflation like for a long time. I mean, seriously. I could even go back, but I won't. But in terms of the podcast, a couple times, as far back as late 2024, I was talking about these things. Really into middle of 2025, later 2025, and of course all year. This is the deflation within. All right, but it gets even more interesting because that means that the participation rate, which I have mentioned before, with all the people telling us it's solid in the labor market, is solid. The participation rate fell again. It's crashing like barely it's ever crashed before on a short-term basis, on a very short-term basis, say, over the last year and a half, to 61.4. This is the lowest non-pandemic number since March of 1976 at 61.3. It is literally a 60-year low, right? The 25, 20, it's a 50-year low. It's a 50-year low. So from that perspective, it's also down from the peak in August of 2023 from 62.8. I mean, it's come off hard. I mean, it's like the only other time we've seen these kind of declines, 2008 and 9 and 2020. Same thing. It's all linked together. All right. And when you get into the educational attainment dynamic around this, those with less than a high school diploma and those with the highest degrees are both suffering huge because they're dropping out like crazy. Employment is actually falling, and that the unemployment rate is lower. It's lower. You also have part-time for economic reasons, which the BLS told us in the text of the report was little changed in July. Not little change. It was up 123,000 to 4.8 million, the second highest of the year, of people that are working part-time for economic reasons because they can't find full-time jobs. So you have less people working because the number for the month was down 23,000, but the unemployment rate still fell. Why? Because so many people dropped out. Not because there's job growth, because so many people dropped out. That's not solid. That's not strong. That is erosion. That is hollowing out, which is what I called it. Deflation from within. But it gets worse. It gets worse. Average weekly income fell. Growth rate year over year fell to 3.5 from 3.7, could say 3.8, depending on the rounding, to 3.5. All right. In December of last year, it was 3.4, and in March of this year, it was 3.4. But these are the lowest rates since the pandemic outside of January of 2024 when it's 3.2. 3.2, 3.4, 3.5. These are the three lowest rates of growth in take-home pay, in what you get in your check when you go to the bank. Of course, inflation means it's already worth less. No one goes to the bank with a check anymore, but you get what I'm saying. But really, here's the rub. PCE inflation is higher than 3.5. And if it doesn't fall this month, later in the month when it's reported for July, that will mean you had deflation in real weekly earnings, income, take-home pay for the average consumer out there for 158 million people working. This is real wage deflation against prices which are going to continue to go higher. What is that? That's stagflation, which again, I've been talking about for months and months and months. All right. Actually, I did write it down. August of 2024 was when I started with the disinflation, deflation dynamic. So, I mean, AI is lurking too on the labor side. The CFO's survey just told us, the CFO Fed survey tells us that most of these companies are spending a lot of capital expenditures to, quote unquote, reduce the reliance on human labor. That's the phrase that was used over and over again. It was the phrase in the response to the question. Mind blowing to think. So the Fed faces now what is the ultimate conundrum. The ultimate conundrum. And I said that. Called it that. Okay? Because you're looking at, inflation that's going to continue higher. All right, the gasoline base effect is 30 to 50% higher through the end of the year. So unless gasoline falls back below $1.65 and it's last at $3.05 in the wholesale level at New York Harbor delivery, it's $3.05. Unless it falls below $1.65. And Trump says it'll be free by October, by the way. It's not happening in terms of lower inflation from gasoline. You have to have too big a fall. It needs to fall by almost 50%, and that's not happening. Why? Because you have massive deficits in gasoline supply in this country year over year and over the last 2 years. You're at a level nominally that you usually see in November when the driving season's over and you're starting to rebuild for the next summer. I mean, this is bad, man. You have a huge drawdown. And the fact of the matter is you're producing more gasoline, and it's still, inventories are falling to danger zone levels. Not only that, but in terms of crude oil, you can't really pump much more. You're producing almost 14 million barrels a day, but the throughput, which means the amount of crude going into refineries to produce diesel, jet fuel, and gasoline, sometimes heating oil, okay, it's over 17 million barrels a day versus 14 million barrels a day that we produce. We might be energy independent because of natural gas. We're not petroleum independent. We have to import crude oil to meet our demands. 3.3 million barrel every day deficit. So don't expect energy prices to collapse. Don't expect free gasoline by October, as the wannabe, midterm election hero will suggest. All right. Now, the first time I mentioned that the Fed would acquiesce to higher inflation to protect domestic final demand growth was actually on December 22nd of 2024. And that's what's going to happen. The ultimate conundrum. Do you raise rates to tackle inflation and invoke the ghost of Paul Volcker and destroy growth and let us be a recession? Well, you can't do that now because of the debt. That's the difference. Volcker had no debt. We got 60 trillion in debt. So you have to, when you're staring into a deflation abyss, 20 trillion of household debt, 60 trillion of we the people's debt when you throw in public debt. This is debt. We own 50 trillion of that 60 trillion we the people own. And it's our own debt. And the government proposed to pay us back with dollars that'll buy less. The big trade-off of this is the variety of them. But I think one trade you got to really watch as a tell that this is beginning to happen is a yield curve steepening. It's already started. The Fed, by potentially cutting rates, all right, and already you've depriced some of the tightening that was priced in from Morse's recent comments in the, overnight interest rate swap and the Fed funds forwards and all the things that are proxies for Fed policy in the markets. They are back down to one rate hike, but that one rate hike either this year or next year will be undone in the second half of next year. And by the end of 2027, we'll be right where we are now in interest rates. Well, that's not going to happen. I would say, if anything, if they hike, it'll be sooner that they have to cut. But ultimately, they're going to have to cut because they have to make that decision, acquiesce to higher inflation to protect domestic final demand growth, because without growth, you can't service the debt. But the inflation will run, and that's where the long end takes the hit. So the curve steepens. And this is why Scott Bessent used taxpayer money to bail out the yen. We'll get to that in a minute, too. But you have so much debt, all right? And you really look at how this has been accumulated. You're talking about Social Security, for example. You take money from new investors, new taxpayers, to pay off the old investors who are cashing out, the retirees who want their entitlements and their benefits, right? This is the definition of a Ponzi scheme. Charles would be quite proud, I think, all right? In the modern day, this is a classic debt deflation and results in a currency debasement. We throw in Iran and Canada, the Democrats, the fraud in the government, and a choking consumer. I mean, this is tough. And I said in my book in 2006, published in 2007, all right, Gold Trading Boot Camp, that when staring into a debt deflation abyss, and this could cause a debt market crisis and a bond market crisis in the U.S. All this goes wrong. And that's why, Bessent was so strong on the end, or weak, as the case may be. When staring into a debt deflation abyss, every central banker on the planet will choose to reflate at any cost. And that reflation comes usually at the expense of the currency. Okay. And again, this is why Bessent spent $9.5 billion of U.S. taxpayer money to bail at the end. Why? Because you have an 18-year high in the U.S. bond yield, the 30-year bond yield. Okay, well above 5% now. You have $60 trillion in debt. You have $1 trillion interest payments, and you have Japan as the largest international holder of U.S. debt at $1.2 trillion worth. Yeah, I did a piece recently. Alfred E. Newman. What me worry? Because this was Scott Bessent. What me worry? Yeah, worry, dude. Because a debt deflation, a bond market crisis, this is not the way to go on this. All right, as the largest holder of international debt, if they dump their debt, that could be a real problem with interest rates. At some point, they'll have this Japanese-style yield curve control and all that. So, it's not a really longer-term trade on the yield curve, but I think the yield curve will steepen somewhat dramatically. I think, of course, all this is bearish for the dollar. We'll get that in a minute. Now, in terms of stagflation, also, again, in March of 2025, I said stagflation is the new trend, and talked about the ultimate policy conundrum, all this stuff that we're talking about. I was talking about this back in March. All right, now all of a sudden it's kind of, making the news. Last Monday, talking about the Alfred E. Newman, okay? But there's more to this, right? Because, is this why Bessent has refunded every dollar of U.S. debt that's matured this year at the shortest maturity possible for the lowest interest rate possible? Does he know that rates are going to be coming down because he sees what's happening? Is this why he was in the yen so aggressively? He should be worried. He really should be. But there's more to this, because as the U.S. short end yields come down, and with forward rates pricing in tightening still, that's another VIG in the differentials against Europe, for example, or Japan, or Canada, or Australia, or China, or anybody. All right, now there's a lot to do with currencies, the yield differentials, which currency you get paid to hold money in overnight. All right, with the U.S. short end rates now narrowing their positive premium. Okay, they're down already. The overnight interest rate swaps and Fed funds, I told you, they've already unpriced some of the tightening. All right, now you're actually looking again into the second half of next year. They're saying we'll be right here where we are with rates, but I say likely lower, because the consumer is already in the 650 billion range of savings. That is such a low level of savings, not even funny. And credit card debt is more than twice that. All right, most bank loans now, we just got this from the Philly Fed survey, are skewed towards the lowest credit scores. So what do we have? We have not enough savings, we have credit use because it's necessary, and we have real income deflating. All right, as the short end comes down and they possibly cut rates, all right, then you're talking about pressure on the dollar. Now, dollar breaking down is a big deal, but let's throw a curveball into the mix, because I love to really contemplate everything, connect all the dots. There's one big dot we haven't connected yet besides China, but that's another story, is the Middle East. What if? I love what ifs. And we used to sit around at the hedge fund at Commodity Corp in Princeton, in the farmhouse where we worked. It literally was a classic, it's an iconic place if you look it up. But the thing we'd love to do the most and would spend hours doing in the afternoons was what ifs. What if this happens? What if this happens? What if this happens? This way, if that happens, we're ready for it. We kind of already thought it through. And what are we going to do? So let me throw a what if at you, as if you're, in the meeting room at Citadel with one of my clients. What if, and I shouldn't say that, what if, they're going to cancel now. What if Oman and Iran, okay, reach a deal on the Strait of Hormuz and includes tolls for both sides, in on the Iranian part, out on an Omani part. Can you say that? Omani? I think that's right. But they also say, as they've been suggesting, no U.S. or Israeli ships allowed. Get the backing of Pakistan, China, some of the Gulf states. If Saudi Arabia is involved and they know they can ship their crude, I mean, what's to keep them from signing up? I mean, we're gonna bribe them with the newest fighter jet, only if we're gonna take them on. Because if they did that, that would be a worst case scenario politically. Absolutely the worst case. Because you got two choices. This is binary. And this is really the way it should have been from the beginning. Either fold before the midterms, or you go full out, boots on the ground, naval air war with Iran. Oil source gets to $150, $200. Gasoline's, across the country at the retail, $5 to $10, and Trump is weakened into the midterms. Maybe, maybe not. Who knows? I would say you fold. Yes. Doing that would hurt the dollar dramatically, especially against the renminbi. And recall, I said the Chinese renminbi at the beginning of the year would be the strongest currency on the planet this year. And it is. Right now, it's beginning to break down, dollar breakdown against the renminbi again. Levels to watch are real key. 95.50 on the dollar index, on the cash dollar index. And right now, 99.40 is a short-term breakout level on the dollar. But let's talk a couple markets and a couple recommendations the last few minutes here. Now, mentioning yen, the Chinese renminbi is really interesting because you had something happen this week that I haven't almost ever seen. That is, the Chinese posted a big import number for copper when copper priced in renminbi was at the highest price ever. They are smart, astute, really good traders. They are stealthy, they're slippery, they're good. I mean, they really are. They're prescient, and they have enough to maybe clout to maybe control these markets to some extent when they want to. This might be one of those times because they don't buy at the highs, okay? They force the market lower and buy at the lows. The problem is they've had a huge decline in copper inventories in Shanghai. They've also increased imports in July after a bad 6 months. First part of the year, they weren't importing a lot, which is why copper and these metals were kind of depressed. They also imported a lot of zinc and nickel too, at the highest prices in a long time, not the highest ever like copper. But this is really interesting because I've said they would behoove them to want a stronger currency. Why? It would keep down the prices of the resources they have to import. And this is the perfect example. They don't buy stuff at a new all-time high, usually, unless they really need it. Inventories of copper in Western warehouses were at 530,000 tons just a few weeks ago. It's down to 220. And below 200 is danger zone. It's almost like there's a squeeze right here in the copper. I don't know that, that demand is that high, but it's really interesting because right now you've seen a big decline in global copper inventories. And what's interesting is the swap rates are always tell, right? You have to pay a higher price to get copper now versus what it costs you over time to warehouse it, store it, and insure it, right? Usually it costs more in the future because of all those added on costs for however many months you're going to hold it, right? So when the nearby price is higher than the future price, that's a sign of disruption and a disconnection in the supply demand, meaning there's not enough copper out there to meet demand, so you're willing to pay a higher price to get it. It's that simple. It's called backwardation. The market is backwards from the normal price structure it should have. All right. Well, the cash to 3-month has flattened to almost flat from a contango, meaning it was ample. Well, it's not ample anymore. It would say it's adequate, but not ample. All right. But the out to 27 months from the 3-month, you're talking about really steep new backwardations, meaning huge price premiums on the front end against the back end, meaning there's not enough copper out there to meet demand. This tells us a couple things. Number one, of course, copper's going higher. I mean, number one, all right? Number two, that Xi would welcome, a move higher in the renminbi. And there's some talk, the IMF said recently that the renminbi is overpriced by as much as 20%. They're talking about a new Plaza Accord Remember the Plaza Accord in 1985? The Plaza Hotel in New York, the G7 got together and decided to work the dollar lower because it was, really hampering global economies, the higher dollar, right? It was epic. I remember that day getting on the train. I was working on the Florida Exchange that day. Got on the train, heard the news, was like, oh my God, this is going to be a hellacious day. And it was. It was epic. It really was. All right. And to that degree, they're talking about a new Plaza Accord to strengthen the yen. Now, I don't think China's going to agree to strengthen the renminbi. I'm sorry. I always get those two interchanged, and it's terrible. To strengthen the renminbi. And if they were to do that, I wouldn't be surprised, but I don't think China's going to go for that. They don't want these sharp, quick changes. What they want is to manage it. All right. But the other thing we learned from this, it's very bullish for gold. All right. And I did a piece. It's funny because I decided to do a piece on copper in terms of this whole, Chinese yen story. Chinese renminbi story. It's a mental block. I've always done that too. I don't understand. Back in the saddle, I called it. Aerosmith, the rocks, back in the saddle. Copper, it was back in the saddle. All right. And the next day I looked at gold and silver and I said, you know what? Gold and silver, back in the saddle. And did that piece on Wednesday. Thursday, back in the saddle, part 3, uranium. So the things I would recommend out there, the positions I have, in the commodities at least, not all of you can do the futures, but I really do advocate the futures. And as a CTA, we can do this very well if you are a wealthy individual investor or family office. The things I'd recommend is COPX, which is the copper mining ETF, the DBB, the base metals ETF, which includes tin, which is always a good one to have. Okay. I like the metals outright. So that means the silver ETF or the gold ETF. The mining shares will come, but it's not going to be the first part of the move. And we'll talk about the mining shares maybe in our next podcast. But right now, it's the metals outright, gold and silver. If you recall, I did say silver below $61 would be a back the truck up moment. Back the truck up, put as much silver into the back of the truck as the wheels will hold, get extra suspension support, and drive away and go to the vault or bury it if you own 50 acres of land, which we don't here in Florida. And then in terms of uranium, I like Denison and UEC. They're low price stocks. You can buy and invest as much as you want, basically risk the entire price. It's like a call option on uranium with no time decay and no expiration date. So I always like that strategy. Used that with the silver miners last year, and it worked out fabulously. But you could also do URA, which is the uranium ETF, or NLR, which is the global nuclear energy ETF. If you want more, or you want to get info on my Series 3 licensed CTA and whether that would work for you and you would work for us, you can email me. You want a free trial to the research? You want my gold and silver piece, the copper piece, and on upcoming, the BLS piece I did today, the uranium piece, and the tomorrow's piece, which will be El Nino, which we haven't even talked about. Inflation and food prices, already cocoa doubling, already coffee way up. I mean, this is going to be big. Sugar's breaking out. El Nino is going to wreak havoc on inflation in the second half of the year and make the Fed's job so much harder. The ultimate conundrum is exactly that, the ultimate conundrum for the Fed. If you want more, any information or trials or any pieces, feel free to email me. It's simple. Sales at Weldon Online, WeldonOnline.com. WeldonOnline.com, one word.com. Follow me on Twitter at Weldon Live. Post a lot of stuff on there, usually stories that are kind of peripheral, but really, tie into the bigger picture. On YouTube, I'm Gregory_Weldon. And do me a favor, give us a shout out on the podcast site on X. All right. On X, it is money_podcast. Anna Janowitz is the really awesome producer of the money markets and new age investing. And she's really likable. So why don't you all hit her up with a like? I know that she would really enjoy that. I would too. Thanks a lot for listening. See you next time.